Welcome everyone. Thank you for coming. I know there's lots of other things to do in summer, so appreciate that you've come. Very interesting discussion tonight with four really experienced investors in the insurtech space, and I've learned quite a heap just from the video interviews we've done, and I'm looking forward to further information. But firstly, I'm not going to forget you tonight. I wanted to introduce you to Tobin Domer. He's one of the attorneys here at Shepherd Mullen. Shepherd Mullen are ahead of the game. They're actually focused on FinTech on the West Coast, which is unusual for a lot of the law firms. And good on them. I hope they benefit from it. But like me, they're pioneers in that. So Tobin actually has sponsored the drinks and the venue for tonight, and he's just going to have a couple of words about Shepherd Mullen.
Yeah, thanks everybody, and I don't think I need the mic. I'll keep it quick.
It's for the video.
Oh,
yeah.
Sorry. We are an international law firm. We focus on tech here in Silicon Valley, and part of our commitment to the startup community is hosting events like this, which are always great. And so thank you all for coming, and looking forward to a great event. And certainly grab me afterwards if you would like to chat.
Thanks, Tobin. Okay, I'm going to pass it over to Pierre now. I think Pierre's our moderator, and he's going to introduce the investors. Thank you.
Hi, and contrary to popular belief, I will not be introducing the investors. They will do that one-liner themselves. There's also great profiles on the website, and I usually like to get right into it so we don't spend too much time with kind of the boring stuff. But I do want them to at least give you a sense of what firms they're from with the one-liner as to what they're doing.
Sure, I'm Ben Harrison. I was an entrepreneur for 25 years, a seed investor for 8, and a GP at a traditional venture firm for 2, and now we're in a small family office until I figure out what the next thing I'm going to do is.
And I'm Ken Elefant. I'm a managing director at Sorenson Ventures. And prior to this, I was at Intel Capital and Lightspeed and Battery Ventures. I focus on infrastructure software and security.
I'm Chris Downer with Excel Innovate. We're a venture fund focused exclusively on insurtech, and within insurtech, the P&C industry.
I am Joe Gazelle. I'm an investor with Crosslink Capital. We're a generalist early stage venture capital firm based in SF, doing seed and Series A investing. I focus on FinTech and insurtech within that fund.
So this is great. So where I'm an enthusiast, these are pros. All these people are putting their money to work in the space. So I'm really looking forward to hearing their thoughts on a number of issues that we're going to talk about tonight. So look, this space is getting kind of crazy. 3 years ago, there was not a lot going on with insurtech. It was a little bit boring, a little staid. But all of a sudden, we're seeing real investments happening. We're seeing insurers in China, for example, raising $1.5 billion or $1.5 billion on a public offering. We're seeing startups in the Valley actually getting their seed rounds closed out at $1 to $4 million. What's going on? Well, where's the innovation coming from? What's this the result of?
So, the thing that's, I've been focusing on this category for about 4 years. The first investment I made was Zenefits, which is actually an insurtech company, and then a company called Cover and a company called IQ. And what I actually found fascinating is that what's going on now is that the seed rounds are ridiculously huge. I mean, there have been, I have an entrepreneur I funded in a prior business who raised $15 million for an insurtech concept as seed off of PowerPoint slides. He's now gone on to raise a Series A, and I think he raised 40 or 50 there. He's a great entrepreneur. It's a great opportunity. What's going on, though, is you've got one of the last remaining spaces in finance that has not yet been disintermediated by technology. And it is enormous. So, you guys will be able to speak to this. Certainly, you'll have really specific views. But my understanding is insurance is bigger than banking. It is just a massive, massive industry that does not have a lot of innovation or a lot of incentive to have innovation. And so it's ripe for disruption, and that's what every startup wants. Startups want ripe for innovation, and venture capitalists want it to result in many, many billions of dollars when it works. And that creates a lot of excitement.
And from my perspective, I sent in this slide last night to PMO, and I think this explains it all, especially from an infrastructure point of view.
So, well, we're done here. Thank you very much.
Take a picture, drop the mic.
But what is different now, Pierre, than what was happening 10 years ago is that there's all sorts of new technologies that consumers are demanding, and insurance companies need to offer them, or they're going to be disrupted. And what's behind those technologies are the infrastructures associated with them, like AI, like blockchain. All of these things, if you think about data, which is probably the most important asset of any company, and certainly for insurance companies, how you actually use and leverage data is completely changing. And so that is what's moving the curve to the right. And the demographics are also changing as well. I mean, what I wanted when I was a 25-year-old is very different from what 25-year-olds want today. They don't want to buy a car, they want to share a car. They don't necessarily want to buy insurance, they just want insurance when they're actually using the solution. So that's what's changing in my mind. I'm very happy to send out the slide later.
Yeah, the insurance market globally is a $5 trillion market opportunity. So people look at that, and as Ben said, it's really one of the last areas of technology disrupting the market. So you look at a $5 trillion market opportunity and you say, well, there's a lot of room for change and a lot of room for disruption, a lot of room for innovation, and a lot of room for growth. So I think we're seeing a lot of companies come into this space looking at that and saying, well, if I can get a piece of that pie, I don't need much, but I can still do really well. And so we're seeing a lot of insurers who are really anchored in legacy technologies. So the insurance industry really is an industry that is incredibly regulated, and because it is incredibly regulated, has attracted sort of very large players that don't really need to change. With the introduction of these new technologies that you're seeing back here, there now is a significant need to change because the consumer is driving a lot of the demand for more efficiencies, a better user experience, you name it. And so insurers are behind the 8 ball here. And so from that perspective, I think that there are a lot of new companies that are seeing a massive opportunity, and a lot of insurers that are also seeing if they don't adapt, they're going to be left behind. So it's a really interesting time within insurance and within insurtech specifically.
Yeah, I mean, I think these guys pretty much said it all right there. So largely analog industry, it's been largely undisrupted by new upstarts, and it's so big and so archaic that everything from the underwriting down to the software or lack thereof software for how these firms are actually managed is an opportunity. And the market is so big that every subcategory in and of itself is a massive industry. You think about just like the percent, what percent of the 5 trillion is renters insurance, for example? Yeah, probably 30 something, I bet you it's $30-something billion industry right there. For us as VCs, if you see, $35 billion on the slide for TAM, that's an interesting space, and that's just a sliver of the overall pie of insurance.
Chris, we're going to have to give you the merit on that one. You guys were investors in Lemonade. Were you asleep during their PowerPoint presentation talking about the size of the market? And I would also challenge that it's actually far bigger than 3 trillion, or 5 trillion. AXA Insurance alone is a $3 trillion assets under management company. So, and that's just, in their sectors, property, P&C, some health, some car. So I think that really you're right. I mean, this is a huge market. And one of the startups in the auto space was explaining to me that, when they looked at the market to go into it, it was an issue around the size of the top 20 companies, top 20 insurance companies. When you looked at them by market cap, there is not many industries where the 20th insurance company is not bigger than the number 1 player in every other market that's out there. So it is pretty crazy how big the market is getting. It's interesting when you guys look at these deals, and you mentioned, for example, Ben, that there was this, the size of the amount of money they're raising and the valuations they're getting. What kind of multiples are we seeing on these companies?
Well, I mean, I think that venture always has to pay it forward. We have to pay it forward in what we have to pay it for what we do, helping entrepreneurs before they need us. But we have to pay it forward in terms of the valuation of the company, the multiple they're going to receive. Right? So if you were basing it on revenue, it would be infinity. Right? Because if you raise $15 million and you have 20% of your company, that's 75 posts or whatever the number works out to be. Gee, well, since you're on PowerPoint slides, I'm paying you something like, gosh, I can't do the math on that. It's like $500,000 for a sheet of paper. But what happens is you sort of think of it as, all right, am I paying it a year forward, 2 years forward, 3 years forward? We all want the same thing. We want something truly enormous when it works out. And the bet here is that the folks that figure it out can dominate, at least categorically, areas of insurance that are worth so much, people have become a little bit immune to the amount they pay. Now, I don't like that. You know, when I was a partner of a traditional venture firm, we had a lot of conversations, which I was trying to push us through on, because I'm probably spending more time on this than anybody else there, about my belief as follows. I think the right time to invest in insurance tech is either right at the concept when it's pre-seed, and you've got smart people with ideas that are actually raising money on like a $5 or $10 million cap and haven't figured out anything at all, and then you just see where it goes, or it's after the race has already started. You know, because you're just seeing so much money going in at such high, it's not even fair to call it multiples. These companies are pre-revenue, right? So when you have a company, Lemonade right now is doing some business with that last round. I mean, you're talking about startups that are already cresting $1 billion plus valuation side in this category. So I don't think there's a multiple answer. I think there's and it's unfortunate when people use it, hey, it's Facebook, it doesn't matter how much we pay. Well, yeah, if you're the dominant player in, say, a $50 billion category and you can take that market share away, it's going to be worth an enormous amount. So I think people have had to force themselves to think differently, and I'll close by saying the competitive pressures also insist upon that because, you know, I said this to a friend once, actually, it's a company that just raised $250 million called Cabbage, and I introduced it to a Series B investor. And he said, you know, I don't think I can do this. This is like 55 times forward-looking revenue back. I was like, look, I think it's crazy too. But I'll tell you this, the entrepreneur's not going to take anything less. So you can either overpay now or you can overpay later. I'm sure he's happy to have paid $55 million for that company that's worth $3 billion than to have waited around to pay $300 million or $500 million for it.
I think the only other thing that I'll add is that the multiples or the valuation that entrepreneurs get is really based on three things. One is the team. Has this team built and sold a startup before? The second is are they going after a small but rapidly growing market? And as we just found out, there's lots of new markets for startups to go after. And then third is what's their differentiation? It could be technology differentiation or it could be channel differentiation. I mean, one of the things that's happening to insurance companies is the old way of selling insurance may not be the right new way of selling insurance. So if you have those three things all lined up for your startup, you can command a very high multiple.
One other thing I'd add to that is commodities, or capital is very much becoming a commodity in the insurtech space. We're seeing a lot of new players come in, whether it be traditional VC funds who are setting up their own insurtech focused funds, or insurers and reinsurers coming in. So just to give you a little bit of perspective on that, in 2012, there was one investment from an insurer and reinsurer into a venture type round. Last year, there were over 100. So this space, just from that perspective, is growing significantly. We're seeing a lot of venture funds coming out of insurance companies. I think last we counted, there was something like 15 or 16 making investments. And so this is a space that is becoming, I'd say, very heated at this point, but not overheated. I think it's one that will have a lot of room to go and should be very interesting to see what happens. But certainly, to Ben's point, there's a lot of money coming into insurtech.
Yeah, it's the hot kind of shiny fintech sector right now, and so it's attracting a lot of capital. And I'm not saying that I'm bearish on the space or anything. It's just it is the shiny object in fintech right now. A lot of money is getting put to work in the space, and I think what we're finding on the early stage is that the cost of capital to actually get these things started and actually underwrite your first policy is a lot more than what I think traditional, let's say, generalist investors are used to. It takes anywhere from $3 to $10 million for some of these companies to underwrite their first policy, and at least a lot of the companies that we see, you're spending all your seed capital to get to the point where you can underwrite your first policy. Then you're raising the Series A. You don't even really know if you have product market fit yet. You don't really even know what you can acquire customers at yet. You don't really even know how your default rates are going to look like yet, or any of the competitive pressures you're going to face. So it's still early innings here. Even for the Lemonades of the world, or the Troves of the world that have raised a lot of money and seem like they look like they have a lot of success, it's still very early.
Hey, Joe, staying with you on that.
Yeah.
There's kind of this weird frenemy thing happening. So a lot of startups are coming in, addressing a very specific part of the value chain, And rather than dealing with the high cost options or the capital issues that are troublesome for them, they try to focus on one aspect of the value chain and team up with an insurer or a reinsurer to support the rest of the operations. Is this a stable situation, or do we envision this as a transitory state before we get to the part where the young insurance company can actually stand on its own feet and then just take out the big guy?
Yeah, so I guess you're talking about a lot of the upstarts that are coming in as MGAs, right?
Yes.
And then partnering with a carrier for their balance sheet and partnering with a reinsurer to kind of remove the risk. Yeah, I mean, if you talk to any of them, if you get a beer or two and any of one of those CEOs, they're going to say that their goal is to eventually be a carrier, which is going to require an astronomical amount of capital down the road, right? And TBD whether it'll work out. So I think, yeah, for now they play nice. For now, all the carriers are playing nice. But I think, you know, once the competition starts really heating up, I don't know if people will play as nice anymore. You guys probably have an opinion.
Yeah, I think what we're seeing a lot is in the initial wave of insurtech, there was an adversarial bent between the startups and the incumbents. And so we really saw the startups coming in and saying, we're going to disintermediate these traditional carriers and we're going to take their business. Really over the last year, what we've seen is more of a partnership model. So really, we really see the collaboration as the way forward, and there's really a mutual benefit to both. The startups need the carriers who have the resources, who have the scale, who have some of the necessary systems in place to grow into. And the carriers need the startups to really bring in new technology, new ways of thinking, to bring in the efficiencies into the market or into their business. That's critical. So really, I don't think it's a zero-sum game. I don't think that there's really a State Farm is going to go to zero because a Lemonade is going to take over all of its business. And in fact, you see the parallels in FinTech. JP Morgan's still around. Goldman Sachs is still around. And so we really see the partnership model coming through. And you can name, I think as Joe said, their partnerships with Nationwide and Insure as an example, or Markel and Next Insurance. These are really gaining momentum in the market. And I think people are seeing that as the way forward.
Question on top of that, I guess I'm sorry, I'm going to ask a question, moderator.
Please.
Do you think that all kind of in that vein, are all LOBs kind of lines of business made equal with that? I mean, like I've always gotten the sense that like auto insurance will have much sharper elbows than, let's say, renters insurance once the real war begins, Game of Thrones.
You know, it's interesting to think about whether something can truly be, whether it's by line of business. And by the way, I think every business has to grow by line of business. If you want to be expert, you know, I founded a company called Cover, which lets you take a picture of anything and you get it insured. You know, and to the point I think you made about the changing demographics of people, you know, young people don't even think about insurance at all, let alone want to buy it differently. But having said that, they still have concentration in certain lines of business, and then they partner with people to cover those. So far, those people all seem to be friendly. It is fascinating how you made the point earlier about like everybody on the old-fashioned insurance side has got a venture arm now, or a strategic. I mean, every reinsurer. Yeah. But so here's a quick sort of synopsis and story. When I first started thinking about this, I thought I needed to understand insurance better. It's an incredibly complex industry. Like, you constantly learn about all these little niches of insurance and how they're regulated. It's an enormous pain in the ass. But if I oversimplify it, you've got brokers, people that sell insurance. They don't actually get to do diddly squat except represent some other carrier. They don't even get to make decisions. Then you've got, I guess the MGA is sort of the super broker, and they get to make decisions and make underwriting decisions. Then there's the carrier, they take the risk. Well, they sort of take the risk. They don't really take all the risk, because what they do is lay off the risk to a reinsurer. The reinsurer is the ultimate source of risk. So you've got all these buckets, and they're all huge, huge agent groups and huge carriers and massively huge reinsurers. I met a guy from Europe, and I didn't know the name of his company. I was like, I've never heard of you guys. He's like, yeah, you Americans. We're the 30th largest business on the planet, and you've never heard of us. we're a reinsurer with, tens of billions of dollars. Like, well, it's good to know, but you're not a household name in my town, so thank you for that plug. I still can't remember his name, by the way. He was so angry. Anyway, as I talked to these groups, what I started to notice, all the risk trickles down to those reinsurers, right? So you have to think about where in the stack the startup can add meaningful value. And it seems very likely that it can add meaningful value on customer acquisition, maintenance, service, customers, all of that, right? So they all start with something. They start by being an affiliate network-based model, and they throw off all their business, or they want to become a broker of record, or they want to become an MGA, or blah, blah, blah. At the end of time, if I'm your investor, and you tell me you're growing like this in terms of acquiring customers, and you can cut a deal with Munich Re to lay off 100% of the risk and still make profit, I don't need you to be a carrier. I don't need you to be anything. I just need you to be an acquirer of customers and pass them along. So it's going to be interesting to see who gets hurt. None of them are going away. They're just too flippin' big. But I'll close it with this. I had a breakfast at InsurTech Connect, and I invited all of them. I invited like 2 or 3 brokers and 2 or 3 MGAs and 2 or 3 carriers and 2 or 3 reinsurers. And it was like, okay, if somebody's at risk, who's going to die? And they all said it was the other guy. I mean, nobody wants to believe they're going to get hurt here. So I think it's a huge question, both by line of business and by category on the insurance stack, who is ultimately the most risk, but I would not bet against the reinsurers because they've got massive amounts of capital and somebody will deploy it for them by being the agent out to the front end, whether it's a startup or a regular good old-fashioned company. And then later we should talk about how hedge funds and private equity will become their threat because they're also a source of capital and risk, and that's the only game these guys are playing.
I think what's also interesting is the insurers, they know that they're being disrupted. They saw the playbook that happened in retail, and they are trying as fast as they can to get ready. So this answers your question in terms of why is the frenemy thing really working in insurtech, because it has to. Otherwise, the ones that are moving too slowly after too long a time of getting disrupted, they unfortunately are just going to be going by the wayside because consumers are the ones that are going to be making the choices at the beginning of the day, at the start of the funnel. But I think, just like you said that, I think the farther up you are in the funnel, the more protected you are today.
So this is a good segue to where are you guys, as you're seeing deals coming to you guys, where are you seeing most of the action? What part of the value chain are you seeing the most activity in? As far as deal flow that you're seeing today?
It's all at the front. It's all in different lines of business, but it's in all of them. Property and casualty, business property and casualty, personal property and casualty, home, car, all of it, any type of insurance. Then you've got the sort of micro insurers, swipe on, swipe off, people creating new business models. But I'm seeing it all in the front end. There's one group, there's a guy out of Allianz, one of these massive groups that has started a sort of, we'll be your MJ for you to take care of all the stuff in the middle. So there is an opportunity for sort of, think of it as middleware, except at a much bigger scale, and it's not just software because it requires regulation. And so people can go out, can you buy a broker's license from somebody that already exists, or do you rent one, blah, blah, blah. But for the most part, front end, dealing with consumer, doing acquisition, being smart about it, coming up with alternative methods and models for it, whether it's per diem insurance or we'll insure your Uber or whatever else.
From my perspective, I'm much more of an infrastructure investor. I don't invest in consumer-facing solutions. So data is where the real money is. If anybody has refinanced their house, I refinanced my house literally like 7 times when interest rates were going down. Guess what? It was with the same bank, and I had to get title insurance every time. And the title insurance companies kept charging me the same amount of money to do the same work that they did 9 months before. So I think there's a huge opportunity for those companies that can actually control the data and be the broker of that data to multiple sources. So think about data on your home, data on your car, data on your children, data on everything. That is a huge source of opportunity, in my opinion.
Yeah, I think what we've seen initially at least is a lot of the opportunities have been on the personal line side. So title insurance, renter's insurance, auto insurance. We've seen a lot of entrepreneurs who are not of insurance but knew of insurance through what they touched or what they saw on the bus or what they saw in their car. So that was the initial inroad for a lot of these opportunities. I think what we're hoping to see as the market matures and as people become a bit more educated about insurance and the complexities within it is it moves from personal lines to commercial lines. So looking at more complex risks, looking at areas of insurance that aren't on the front lines, because that is a massive opportunity. So it seems as though that while we're in the early stages of, or sort of a way through the personal lines goal, we haven't even touched commercial. And I think in many ways, that's what we expect to see the next round coming through.
Yeah, I would agree with all these guys yet again. I think that we're seeing, at least I'm seeing companies up and down the stack. I think less innovation on the underwriting front, and it's more just prop up an MGA, go after a personal line, approach it with a really slick brand, and go to market in a way that resonates with younger demographic. And we're also seeing kind of some new companies pop up in and around IoT and smart homes selling to insurance companies, which is pretty interesting. Companies like Flow, which is literally a smart IoT water valve. A huge issue for homeowners insurance is when you get a leak in your home. Most people, if you've owned a home, you've probably had water damage or a leak. And these guys are selling directly to insurance companies versus going direct to consumer. So we're seeing innovation kind of all over the place.
So, what's going on in China? It seems like there's this sudden influx of activity, just huge activity. Like when I read the stuff on Zhong'an, they're raising this 1.5 billion, but this is a company they've done $7.2 billion in insurance policy, 7.2 billion insurance policies, 192 million customers served, $500 million in gross written premiums. I mean, this is some huge numbers. How are you guys thinking about that? Or are you looking at it as a proxy for what could happen here? Or the other way, saying, hey, here it's a little bit more limited, but we need to start looking outside of the country to opportunities. And why don't we start with you guys on that?
You have experience in China. So we don't do any investing in China, but speaking to insurance in China, it's growing gangbusters, and it's still very underpenetrated. I think the average globally is 62% insurance coverage in most countries, and China's only like 40%. So it still has room to grow. And they also, I think, because of the widespread mobile adoption there and kind of their openness to purchase things in like this piecemeal mobile fashion, they're really open to these kind of unique policies. I've even heard an entrepreneur told me that there's a company that sells policies in China for like life insurance for alcohol poisoning. Like they'll shoot it to you via mobile if you're out late at night and they track you and GPS that you're out at the bars. Like buy life insurance right now for $1 for alcohol poisoning. So the opportunities are endless, I think.
Talk about micro targeting.
Yeah.
Yeah, we don't need to state the obvious and say it's a massive opportunity in China. We currently are not doing anything in China. We've got an investment, microinsurance investment focused on Southeast Asia, but nothing currently in China. But absolutely, it's an opportunity that is ripe for growth. As Joe noted, there are a couple interesting stats on China. The insurance penetration rate as a percentage of GDP in China is 1.5%. In the States, it's 7%. So you scale that up, there's a lot of room to grow. On the mobile side, 15% of insurance is already purchased on mobile within China, and that's about 5 times more than here in the States. So they've got a leg up in terms of the technologies and people wanting to purchase insurance on the web, on the mobile, et cetera. So from that perspective, I think there's a lot of room. There are obviously some interesting regulations that you need to be thinking of as you're going in there, and we haven't really looked at that deeply enough to get comfortable, but it's certainly something to be aware of. But a very large opportunity and one that is going to only grow further from here.
And just to push on that, are you looking at those markets and saying, hey, when we see this mobile penetration, for example, in Zonghai, I think almost most of what they do is online. So they don't even have a physical model. Do you look at that for startup opportunities here that might offer a good return or a good sized business?
I think it's definitely interesting to keep in mind, but within emerging markets, and you can take China as an example, they aren't encumbered by the legacy systems. There isn't the traditional, oh, you need to fill out 10 forms, talk to your insurance agent, he'll call you back in 3 weeks, and then you'll have your policy. They've skipped that. So there's a bit of, I think, there's more of a go around here in the States, and there's not exactly a point A to point B. It's going to be non-linear in that respect, but it's certainly something that you can keep in mind as you say, this is what we hope to see.
And I want to open it up to the rest of you guys on that topic specifically, because what you're saying is fascinating when I think about the disruption that startups are actually opened up to when coming into the States. The fact that there are a lot of encumbered models. Today, insurance companies have these large systems that they're operating in-house, large staffs to run all of this stuff. Whereas a startup can come into that space with a cloud offering and a reduced staff because they're going to do everything mobile. Isn't that playing a role a little bit in how we're seeing all of this start to happen? Where the insurance companies are playing a role in areas where they are good, the data, but they're not so great in these front-end systems that they've had to, legacy that they've had to maintain.
That sort of goes back to my view that it's all about the customer acquisition. If you've ever heard the CEO of Oscar pitch, what do they raise? Is it $3 billion so far? And they can insure in one state. Maybe they're up to 2.
They partner with Humana.
There you go. So his pitch boils down to, we don't suck. Insurance sucks, but we don't. The process you go through sucks, our process doesn't. The way they treat you sucks, but we treat you well. It is basically just a we don't suck model. So we are enhanced as startups in this community by having a pretty crappy product experience. Who here, okay, I'll instead of saying who here trusts their insurance company, raise your hand if you really believe your insurance company is going to do the right thing for you. I apologize to Excel Innovators being associated. Who here believes they have your best interest at heart and that they're in the business of paying your claim? Right? Nobody. They're in the business of collecting your premiums and paying out as little as possible. And even if they're run by good and honest people who are doing their job in a normal and appropriate way, that person on the other side of the phone is trying to find a way to screw me, I can guarantee you, because I've been through that before. And so even if I'm wrong, and even if this is just a mythical belief structure, it's still embedded in most of the American psyche. And so the we don't suck and we'll treat you fairly, or a lot of the we rebate your premiums and all kinds of stuff. We're the good people. It's interesting though, I tend to not pay an enormous amount of attention to China because I, like so many others, can't invest there. But I will comment that a lot of the innovation in insurance actually started coming out of Europe long before it hit here. There was a WeSurance as a company where you could sort of aggregate a group of friends and you could share, premiums or share the, raise your deductible. There were some really interesting models. I was fascinated. None of them made it here. But I think each community has its own cultural norms and experiences, and they will evolve to fit those. And we have a lot of legacy crap to get past.
Yeah, my sense, Pierre, is that where you're going to see phenomenal growth is in geographies where it's greenfield, like China, in consumer-facing solutions where the consumers are demanding something new, or in completely new spaces, like cyber insurance. That is a space that I would love to find a great startup in. Not that they're going to provide startup insurance, cyber insurance, but that they're going to provide solutions, data, services to cyber insurance companies. And I was astounded with the growth of cyber insurance. I was looking up some stats this morning. There's an insurance company called Market Corp that went from number 116 in 2015 to number 16 last year because of their growth in cyber insurance. So it's a huge market that is growing extremely fast, and I think there's still pockets of greenfield.
Yeah, there are whole prairies of greenfield, to your point, talking about cyber insurance. You're talking about cybersecurity is the number one thing that every CISO is thinking about before he or she goes to sleep and before he or she wakes up in the morning, and it has not changed since it's been created, and the underwriting standards have not changed since it was thought of either. These companies are still underwritten for cyber insurance based off revenue and nothing else. I could think of 20 other things right now. We could think of 200 different variables that you could probably underwrite a company on for cyber insurance aside from just revenue. Like how about their servers or any of their data hygiene or their integrity or the software that they have in place today. So it's just a ton of opportunity there. And then to your point on the consumer facing stuff, like as a startup, it's a beautiful thing because you just have to compete with this really, really crappy customer experience today with a DMV-like customer experience. And so you can do pretty much anything. It's very tough to screw up the product experience as a startup. But the challenge is that to get up and running and to get off the ground and to really compete at the big levels, it still takes a lot of money to get these things moving. It's not just, two guys in a garage.
So cyber insurance that's a great one. I was talking to a 25-year-old who just got into the insurance business, and he said to me, what areas should I be going into? And I said, cyber insurance. It's like, oh, that sounds scary. I'm like, yeah, but look at every day in the news, somebody's getting their servers broken into. So it's definitely a great greenfield opportunity. So what other greenfield opportunities are you seeing? I was the other day, or actually in the last 3 months, I've now seen, sorry, I take that back, more like 6 months. I've seen like 5 different companies who are offering diabetes management for people with type 2 diabetes, better management of their type 2 diabetes. Because for insurance companies, if they can manage somebody at type 2 diabetes before they get to full-on diabetes, they're able to reduce a significant cost savings to them. So this is a play more, an insurtech play where it's a service provider to an insurance company, but also these companies start out life trying to be a consumer solution, and they realize that distribution is more easily done through the insurance company. Are you seeing those kinds of innovations, and do you have other examples of those that you've seen?
Well, what I'm looking for is more on the infrastructure side. So, let's talk about blockchain. Blockchain can do a lot of different things for both the insurance companies as well as the consumers. So, how many times as consumers do we need to fill out the same forms in terms of, what my name is, what my social security number is, but just think about all the assets, my house, my car, all of that information. Ultimately, that is going to be housed just on blockchain, and that is going to be the source of truth. That's pretty powerful. But more importantly, I think blockchain, at least in the nearer term, is going to be used for making transactions a lot more efficient. So a lot of insurance companies need to do transactions cross borders, so take foreign exchange. There is absolutely no reason why that cannot be managed through blockchain. But why is that going to come off more slowly than a lot of these other greenfield opportunities? It's because you need to repurpose business processes. And inside of large companies, that always takes a long, long time. That's why the front-end opportunities is where you're seeing a lot more uptake in the shorter term.
And just as it relates to blockchain, I think we've heard a lot about blockchain as it relates to insurance, and we haven't yet seen a lot of momentum. So there's the B3I consortium with I think it's like 15 insurers now in Europe who are getting together to talk about blockchain and to make it work. But really, what you need is you need this group to take a step forward and say, all right, we're all going to do this together, because blockchain doesn't work with one insurer; it has to work with the entire group. And right now, I think these insurers are a little hesitant to take that step. And so from that perspective, while blockchain is what we view it as a very interesting technology, there is not yet a solution that is available in the insurance market. But that's not to say it's certainly going to come, it's just a matter of when.
Yeah, completely agree.
I think the most exciting opportunity for blockchain insurance is title. I've been looking for a title insurance play for years. And I almost talked one entrepreneur into moving into it, but he decided to do something else. I think that it's a ridiculous industry where the margins are almost absolute. Even the people that sell it hate it, as I've been told. I know a guy that owns a big, real estate brokerage firm, and he says, I despise the stuff. It's like, I have to sell it, and I get nothing for it, and the other guys are getting 92%. It never gets challenged. The payouts and title insurance are like that. It's interesting though, the question around Greenfield, because remember I said at the beginning I funded 3 insurance tech companies. I just realized I funded 4 because I funded Omada Health. And Omada's model was, we will keep people that are pre-diabetic from becoming diabetic. And the entire pitch was to the self-insured Fortune 1000 because it costs $500 a month to have somebody use Omada. It costs $2,500 a month to have a diabetic on your payroll. So there are lots of, what you're going to find is that entrepreneurs are the masters of the creative thought process to take something that exists today, something that existed yesterday, add 1 and 1 equals 17. And that's what many of us look for. It's just, how do you think differently? I think microinsurance is a good example of that. There was no possibility of doing that before. Even, you look at sort of by the mile insurance that's happening in auto, that's an interesting new way of approaching things. There aren't that many players doing it yet. A lot of the insurance companies have been fascinated for quite a while with IoT. I haven't seen a lot of stuff get executed there, but I can certainly see how. The most interesting one I heard was, and this is on the commercial side, there's some things, Next Insurance is on the commercial side, right? So there's some people starting to dabble in commercial. Freight from China to the United States is a big opportunity as an example. But they were saying that what they wanted to do is have IoT sensors on shipping containers so that when you insure a ship and it drifts into the dangerous waters of some war zone, you instantly get an alert back at your home office, hey GE, your ship just drifted into Syrian, target range or off the coast of North Korea or whatever. We are now going to quadruple your premiums unless you get that ship out of there, or we'll be canceling your policy. Those are the choices. So by having real-time detection, they can live, and in fairness, this should, for all my ragging on insurance, this should enable fairer pricing. I would be very, very happy to pay for the appropriate risk I am bearing as a business or as an individual. And if you can match appropriate risk to appropriate pricing on the other side, insurance companies should be able to make a profit. But, balancing it off. So I think that a lot of the things are going to be greenfield. We haven't thought of yet. People will find a new way. Well, one last one. Fascinating insurance opportunity for earthquake recovery.
Parametric, yeah.
So there's lots of, and they don't even, by the way, this is pretty cool because the opposite of I'm going to find a way to screw you, if there is an earthquake in your zip code or census region, they send you a text to confirm that it was actually true, and then they just send you money. You have to do no claims. It's meant for you to be able to rebound. And it's a really cool, that's a new idea. Like, no claim filed at all. You get told, you just qualified for $5,000. Click here. Pretty cool.
Yeah, I think parametric and earthquake and all those are some of the most interesting ones, but I'm not seeing a lot of startups going after that space. Like, we should all probably have earthquake insurance if we're living in California and own any assets, but we don't. It's just because distribution's tough and it's expensive. Why isn't it cheaper? Because underwriting those policies is expensive to do it manually. To find the customers is expensive, and I'm sure a startup can do it better. So.
Yeah, AXA Insurance invested in a crop insurance company that was using parametric. Yeah. So in Africa, it was just hard to be able to track all of these. So if the temperature stays below a certain amount or above a certain amount for a certain number of days, they just pay out. Mm-hmm. So it really is happening, and we'll see how far this goes. But I'm starting to see.
One of the very first exits in insurance tech was Weatherbill. Remember this?
Weatherbill used to be called Weatherbill, and it was called Climate Corp. I thought they bought it for $1 billion. It was pretty much the first insurance tech exit, and what it was providing crop growers, farmers with insurance that was measured by, hey, if it doesn't rain, you get paid. So there's actually not just been a success, there's been an exit, which is a nice thing. Venture guys like liquidity.
Start thinking of some questions. I'm going to ask one more, then I'm going to throw it out to the audience, so just keep in mind. So when you guys are looking at investment opportunities now, give us a sense in this market, if it's any different than other markets you've looked at. How do you go about assessing whether an insurance play is an adequate investment for your firms?
Sure, I'll take a stab. So we look at insurance tech investments a bit differently, particularly if it's like, let's say, a personal line MGA going after renter's insurance or homeowner's insurance or whatever else, just because we've come to terms with the fact that these things take a lot more capital to get off the ground than, let's say, your average personal financial management app. And so our expectations shift. When we're typically looking at a generic seed investment, we're telling ourselves, okay, how much money have they raised in the seed? Or how much money do they plan to raise for the seed? And do we think that they can get to product market fit with this money? And that's usually the bet that we're making. And then for the Series A, we're saying, okay, they should have product market fit by now. Do we think that this is actually the appropriate business model to scale? Do we think they're actually going after the right customer to scale into what we hope will be a really, really big business? With insurance, it's all just brought back a click, right? It's, do we think they can get to their first policy with the seed capital? And then given that what's going to happen post Series A is pretty unknown for us typically, and we have no idea because we have no data to go off of, we're just doing a lot of market research and trying to get really excited about is the way that this company is approaching automotive insurance super compelling, and do we think they can actually build a big business here given the 10 other startups going after the space, given the 4 failures in the space before, and just trying to basically do that calculus to back into conviction to do a deal.
So all we do is insurance investing. So it's pretty easy. That's all we're going to do. That's all we're going to look at. But I think what's really important is not to underestimate the complexities of the insurance market. We've seen a lot of entrepreneurs come in and say, I'm going to disrupt the renter's insurance market, or I'm going to disrupt the title insurance market, and not really know the regulations behind that. So having a deep knowledge of the industry that you're looking to disrupt is critical. So we focus really, really hard on the team. Does the team have the ability to think about the issue, but also to have the knowledge that they can leverage from past experiences and bring forward to their new venture? Scale is critical for us too. We've seen a lot of very interesting products that are masquerading as companies, but what we're really interested in is an interesting company. And a company that can, 5 years out or so have the equivalent of something like $100 million in revenue. And however you want to measure that across what revenue is. So that's important for us. And then for us, what's really important as well is a company that can bring real change to the P&C industry. Efficiencies are great. Efficiencies can change businesses, but efficiencies in our mind aren't going to be transformational. And we're looking for transformational businesses that can scale and that I think, as we mentioned before, that can exit. And so that for us is really important.
Yeah, I think the criteria is exactly the same in terms of investing in startups. You want the team, you want a small, rapidly growing market, and you want some sort of differentiation. The thing that I've been seeing that is different is that these large insurance companies are willing to partner with startups, and that really is unique, and that's been really coming to fruition over the last 5 years. So when we look at startups, especially because they're usually data or infrastructure oriented, that initial partnership can really provide liftoff for startups. And that would be the advice for entrepreneurs going into the space.
So, in every industry I look at, I want the same 5 things. People, a great idea, and a huge market if it works. In insurance, it's all going to be a huge market if it works. So I'm very focused on the people, but I'm also very focused on the idea. 2 out of 3, or maybe 3 out of 4 of the insurance tech companies I've funded myself have been some version of the Trojan horse. So Zenefit's model, for all the interesting challenges they came through, it's still worth a couple $1 billion in theory. They were providing a free SaaS solution that was as good or better than something the companies were paying for. And by the way, if you just want to flip us over to the broker of record, that would be great. So they give you something for free, and then they make $1,500 per person in your employ for having done it. That's awesome. Health IQ, they're using fitness tests to find out how knowledgeable you are. And if you're knowledgeable, because there's a real adverse selection process in life insurance, who here goes out and looks for life insurance when they're young and healthy? And not normally the case. It's like, oh, am I going to die? I better get that life insurance stuff. So, he goes in and not looking for people that want life insurance, but want people that are leading really healthy lifestyles, and then offer them discounts on that life insurance. And so he's got another way of going in. He's built a phenomenal funnel. Cover, it actually was something very different than it's generally true that these companies take a lot more money. We had a group of guys from the US come out and pitch us on a deal. It was a seed deal, it was PowerPoint. When they were done, they said, we need $30.5 million to get started so that we will have a product to offer, period. We won't have anything until we spent that much money. It's like, you've got to be kidding me. Like, did you just arrive in Silicon Valley and not understand what we do here? But they had done it before. They were going to build an insurance company from scratch. It takes a lot of money. Cover was fascinating. It was a small group of 3 founders, and or 4 founders. They just tried things until they figured something out. And I would recommend that people that are thinking about going into insurance tech, yes, you will ultimately decide to be a broker or an MGA or a carrier or whatever else. But when you're figuring out consumer interest, consumer demand, consumer patterns, you can get a relationship, even if it's an affiliate style relationship, to just pass it all through. You don't have to make any money on those initial policies. You can pass them through to other people who can make that money. What you need to figure out is who is going to buy what from you and why. And in order to figure that out, I'd actually rather you not spend $10 to $30 million building a firm that you don't know if anybody's going to care about. So, that part of the people that are being creative and finding different ways of thinking about things definitely has always appealed to me.
So I'm hopeful that this has prompted some questions from the audience. Does anybody have a question they'd like to ask? Wow, insurance is a weird way of, just, I mean, it was boring before, it's exciting now, but it's not inspiring questions. So I'm going to keep going. So one thing, I'm sorry, awesome.
If he speaks up, he can do it.
You were going to talk about hedge fund and private equity money in the space. Would be curious to hear about like alternative capital pools moving into the space.
So this is based on my thesis that on the front end, you've got people acquiring consumers, and on the back end, all the risk and money flows to the reinsurer. And everybody in the middle is a layer of service, which may or may not be valuable. But if you start to think about what reinsurers do, they are a source of risk and capital with long windows, right? They don't need to mess around if something goes wrong this year. Well, that is also the description of a good private equity or hedge fund. So if you think of Two Sigma in New York, phenomenally smart people. They actually did a joint venture with one of the large insurers and blah, blah, blah. I mean, their jobs are somewhat, a reinsurer and a hedge fund can have very similar jobs. Here's my risk, here's my return, here's my time profile. So over time, as you've got the ability to acquire customers through all these interesting startups, so think of that as demand, right? If you can create demand through startups, what you need to feed it is the supply of money and risk. And I don't see why it won't be the case that over time, as those reinsurers become more and more powerful, all the other sources of capital, and by the way, this is just like in venture, you now see sovereign wealth funds and all kinds of stuff. Everybody needs yield. Well, if you can, what does private reinsurers want to make, 15% per annum? Is that about fair? Doesn't sound too shabby. I mean, there's a lot of hedge funds out there that are promising a lot less than that. So, if you've got a couple $100 billion and you can funnel it into this, it seems like a smart thing to do.
You see any difference between the innovation that's happening in the personal insurance side versus commercial insurance? Is there any fundamental difference, or are they pretty much the same collage of things that's happening?
Yeah, I think there's a difference in the timing, a difference in the number of companies. So I think, as I alluded to before, the first wave of insurtech really was focused almost exclusively on personal lines, and commercial lines was something that was more of an afterthought. The way we look at it at this point is, of the total addressable insurtech market, only about a quarter of those companies are focused on the commercial line side. And within that space, it's really, those companies are focused primarily on small and medium businesses and on the distribution. So there's a lot of room to grow. In the US alone, I think the total commercial insurance market is over $300 billion. And so we're just hitting the tip of the iceberg. So we're hopeful and we're excited about companies coming in to address marine, to address cargo, to address facultative reinsurance. Terms that if you're outside of insurance, you don't really think about. And that really is a huge opportunity. Those opportunities we don't think will be coming from FinTech entrepreneurs who are coming from the outside, but rather people within insurance who are saying, I've got a better idea. I think I can do this better. And so that's what we're hoping to see really come through over the next year and a half, 2 years, whatever it takes. But I think there needs to be some patience there, because the problems that you're addressing on the commercial side are much more complex than determining what my auto insurance is or how much I should be paying for renter's insurance. So, but we're looking forward to that.
Actually, it's a really interesting point, because you're right, there's a lot of people that are doing personal are startups with absolutely no experience in the space. when they're attacking commercial, Next Insurance, there was one in New York whose name I'm forgetting, Cover Wallet or Cover something. They all have the word cover, and the company has cover in it. It's an insurance company. They were doing the same sort of thing. They were trying to do different lines of credit, lines of insurance for different types of businesses, usually SMBs. They'll start with an industry. And they pretty much tried consumer-facing approaches. And the consumerization of technology has made that make a lot of sense. But it didn't work as well as they wanted it to. One of them tried a honeypot approach where they put all this great content. They all said the same thing. Buying business insurance sucks. You don't know what you need. It's complex. We'll make it easier. We'll give you all this information. But from what I can tell, that model didn't seem to work because at least two businesses that were attacking it that way pivoted. So I do think there's going to be a need for more specific domain expertise. There was another really fascinating company out of Connecticut that also exited, where it was a very senior guy out of Marsh who built a business that was sort of half data business and half matchmaking for reinsurers to match up to, massive amounts of money flows around. So they just connected those two. Risk Match, I think was the name. I don't know if what happened with him was public or not, but it was a great outcome. He did exceptionally well. Super smart guy. But he came out of, I sat with him 5 or 6 times. And, I don't think I'm an idiot, but I think there's plenty of stuff he was telling me that took me a long time to truly, it's just incredibly complex, the kind of stuff he was working through. You'd sit there after an hour and think, well, I got 45 minutes of that, but 15 minutes, I'm just not sure I have a clue how that's going to work. The point I will make, though, is, well, I think it'll be a different type of people. It'll also be a different type of investor or a different willingness to take risk. My attitude about investing is if I don't know what I don't know, I'm an idiot to write a check. If I know what I don't know, I can probably pay somebody to help me figure that out. And I think when you get into the more complex commercial products and you don't understand the risk factors that underlie it and all the things in the past that have happened and the regulatory issues and everything else, it creates a much more challenging set of investment opportunities, which is probably why there's so many people that know their stuff that are going to be doing exceptionally well in it.
So, do we have another?
Yeah.
Okay. All right. So, if we cut it slightly differently from a perspective of health, life, auto, P&C, which of those verticals do you see as having the greatest opportunities for startups to disrupt or to actually make a difference in? Or put differently, what do you see inbound coming to you out of those sectors? Which areas are you seeing the most activity from?
So from my perspective, I think where the first change is going to happen is where the lifestyles of the consumers is changing. So if you look at autonomous cars, the thesis is that there's going to be a lot less accidents, right? But there is going to be a lot more security issues associated with autonomous cars. And so that is an area, if you are just an insurance company focused on auto insurance, I would say that you are probably going to be disrupted if you're not looking ahead. There's so besides the behaviors of consumers, the other thing that's happening is that there's new data that's out there. So think about all of the data that's coming from satellites now that we did not have 10 years ago. So there is so much data in terms of what's happening in different locations. We talked about weather before. The companies that can actually incorporate this weather, and startups are very, very good at incorporating new data. If you can have a better way of offering insurance based on new information that other people don't have, that I think is disruptive.
Yeah, we're seeing, I think everything's an opportunity for a startup right now, and we're seeing interesting companies across every single type of insurance. One of our companies just pivoted actually into a workers' comp insurance space. So talk about the unsexy, huge markets. That said, I still go back to it's really early innings. So I think a lot of these folks are going to make a lot of mistakes before we really understand what's going to work and what's not going to work. And it's still very early here. And I just think the real kind of competition hasn't really heated up. So we'll see. I think 2018 is going to be really interesting and really big for that. Either we're all going to stop putting so much money into this space, or we're going to double, triple down, right?
Startups start with the letter B.
What would be?
The one that pivoted?
No, with the letter F.
Oh,
yeah.
The one with the letter B should pivot and that's it.
Yeah.
It's interesting. I was at Y Combinator for the last 2 days, and there was only one insurance tech pitch. I ran into them in the hall, they came over and I said, oh, your name is cover something, you must be in insurance. And they said, yeah, we are. Okay, what are you doing? And they said, well, we're doing real estate insurance and we rebate you, blah, blah, blah. I was like, okay, good to know. Your Lemonade's about 2 years ahead of you with 100, 200, 300, or $500 million more than you have and a partner. And so why do I care? I mean, I think a lot of these categories, the space is already inked in. It's not that first to market will win, that's not necessarily the case. It's that there's a lot to market right now. I mean, there's first, second, third, fourth, and fifth to market in a lot of categories. So if you're thinking, hey, wouldn't it be great to start something in insurance tech, try to find one that other people haven't hammered on for a while, because they've just got so much sunk into those. I'm looking at this for years. It's exciting now, but here's the tricky part. Entrepreneurs, when things don't go as planned, when I was a seed investor, they would call. They'd say, hey, it didn't work out. We're thinking about some new things. Can we sit down and brainstorm with you? And the first question was always the same. By the way, just tell us, what's hot now? My answer is always the same to that. That is the wrong question. You need to figure out what's hot 4 years from now, 5 years from now. Because if you're doing what's hot now, you're already too late. It's not that it's too late to get into insurance tech, but I think the major lines of business have enough people competing to figure this out with enough money that I don't know who's left to fund home insurance company number 7 with another $15 million. And remember, one last point, every investor that has an investment in that space is now conflicted out. So if there were 7 companies that raised from 3 venture firms each, that's 21 people you can't call on. So look for niches that are huge, but aren't paid attention to yet, I still think. Title. Everybody here, go run and do title.
So we're going to end this. I'm only sorry. I really wanted a trick question to be the last one, and I kind of thought we had 2 more. But I wanted to see if you guys thought that any company would ICO their way into the insurance space. But we'll let that be the end of the conversation and settle with that. People?
Thank you so much. Thanks, Pierre, and thanks all the investors for a fabulous panel. I only got to hear half of it, but I'll watch the video. Thank you so much.
Thank you.